Good morning to the BF Anderson Technical Report for March the 10th. I want to get right into the charts this morning. We've got a lot to cover. Been a good week for the market. First thing we need to look at here is the 10-year U.S. government Treasury yield. Now, when I talk about interest rates, and I've said in the past, the most important factors when it comes to understanding the stock market is interest rates and corporate earnings. I would say pretty much ignore everything else. Now, there's going to be a lot of other information that comes across the media, but interest rates and earnings are the two most important economic factors. Now, when interest rates are going up, now let me clarify here. The Federal Reserve sets the discount rate, which is an interest rate that they lend money to the banks. It's a man-made set rate, and there's a correlation with the Fed funds rate with the 10-year Treasury yield. Now, this yield, what is different about this yield is that this is a market set yield. In other words, the marketplace determines the yield. Now, you can see here what happened, right after the election. Interest rates spiked dramatically. Now, realize back here in July, the 10-year yield got down to the lowest ever, to 1.33. Again, remember, for the last 200 years, the average yield on the 10-year Treasury note has been 5% per year. So 1.33 was the lowest rate, even lower than the rate during the Great Depression. Now, I do have a theory, and my theory is that interest rates do correlate with economic activity, so that when the economy starts to pick up, interest rates start moving up. So you can see here the election. Then we come up into here, we get into a trading range between 2.6 and 2.3. Well, as of this morning, we are at 2.61. We are breaking out to the upside. So what this is telling me is that the market is discounting a healthy economic situation going forward. Is the GDP growth rate going to climb is what it's asking. Now, here is oil prices. I just wanted to mention oil briefly. A dramatic drop in oil. We've seen this is a bear market in oil prices. And what's going on here, I believe, is that fracking technology is becoming so good that they're able to get their drilling costs down dramatically, and as a result, they're overproducing. We are awash in oil. So oil has broken below $50 a barrel this week. It was about an 8% drop in the price of oil in 2 days, and it's just just something I want you to be aware of. Now, here is the S&P 500. I wanted to show you what a bull market truly looks like. Now, I'm taking the S&P 500 from 1994 till the end of 1997. Now, the whole point of this exercise is to understand volatility and to understand trends. Remember, the trend is your friend. So the objective here is to get from point A to point B. Now, if you use moving averages, and let me set the graph up, we've got the 30-week moving average. This is a weekly graph, a weekly price. This is the 30-week moving average, the 40-week moving average, and the 50-week moving average. So blue over red over green. Now, as we lifted off in 1995, now these were stocks that we were getting involved in at this time, were things like America Online, Yahoo, Cisco Systems. Then we get down the road a little ways, we're starting to get involved in things like Amazon.com. This was the beginnings of the .com bull market. So you can see here, though, and the point to be made is that once we made the liftoff, and if you kept an eye on the moving averages, things stayed very smooth, very nice. Now, you did have corrections in here, and more than likely, a lot of people would have panicked out of the market during this. But if you'd kept an eye on these moving averages, it would have kept you in and gotten you from point A to point B. Now, one other note. As an observation of human behavior, and I say here, let's go to California for the gold, because what happened during this period was people were not interested in the stock market at all back here. But our phones rang off the hook up here. So what I'm saying is that the key to understanding a bull market and understanding trend is, as long as the trend stays up, you stick with it. But the objective, of course, is to be there when early in the game, because if you wait too long, you end up coming in at the market top. Let me give you another example of a very nice, smooth bull market. This is 2012, going on out till 2014. Again, you can see, how nice and smooth the moving averages were. Again, you did have corrections in here. You had corrections in here, but the moving averages would have kept you pretty much in the game. Now, I intentionally set the graph up to bring you up to date as to where we are now, but I stopped the graph. I went from 2014 till August of 2016. Now look what happened here. It looks like spaghetti. Everything just got all mixed up. Big drop, big drop. I believe, and this is my theory, I believe that this is a bear market. This is what a bear market looks like. So if you think that this particular market that we're in now, and let me just go ahead and bring it on up to date here, and we went through this. What I am saying, 2015, 2016 was a bear market. Now, if you compare this current bull market to history, patterns of the history, I would say this looks very similar to 1952, and it looks very similar to 1982, 1983. Now, if you remember, the market lifted off in 1983, and this was right after Ronald Reagan came in 1980. We went into a nice bull market, but then we hit the crash of 87 roughly 4 years later. The market dropped about 30% in one day, but it was a real quick and fast bear market. It dropped dramatically in October of 87, but by January of 88, we're back making new highs again. So why is this important? It's important because in 1987, the market continued to climb after the crash, and starting in 88, the market continued to climb till 2000. So that was basically a 12-year bull market. I'm hoping we're looking at that. So if you realize what's happened now, we've had this bear market that I would say is like the 87 bear market after the 83 liftoff, but this was different. This was a real lengthy bear market. This was like this was actually a 2 to 3 year top of the market that it just couldn't seem to get through, and you had these terrible drops along the way. It was a very difficult time to make money in the market. Now, all of a sudden, we're starting to see these moving averages starting to come out, just like I would want to say the moving averages started to come out in here, where you started to see the movement there, or coming out like in here. So what I'm saying is that I believe we've started a multi-year bull market that could potentially last, decades, if not, 10 years, 5 years, something like that. But I just wanted to point out that I do believe that the 2015-2016 period was a bear market that ended the bull market that started in 09, which was an interest rate driven bull market. Now starting here in 2016, 2017, late 16, early now in 17, we've started what I would believe to be an earnings driven bull market, new bull market. Now, I attended a seminar recently hosted by Dr. Scott Galloway. He is with the School of Business in NYU Stern School of Business. Dr. Galloway is an expert on digital businesses, and he basically says there are 4 leaders of the economic universe. He calls them the 4 horsemen of the internet. They are Apple, Amazon, Google, and Facebook. So what Dr. Galloway has pretty much convinced me of is that these companies will be the primary driving forces of the economy. You just cannot afford to ignore them. Now, when he refers to Apple, he basically says that, Apple's got proprietary products. He's got luxury. They have luxury products. The iPhone is considered a luxury item. Their profit margins are holding up. But the only problem with Apple is they're suffering from low technology. They need to get new things out there, but they currently dominate over 90% of the profits of the telecommunication industry. This is a very powerful company. Now, he also mentions Amazon. And you can see here with Amazon, I'm using the same moving averages and so forth. But with Amazon, he is of the opinion that Amazon will be the first $1 trillion company. the thing about Amazon, the one problem they've got to solve is what we would call multi-channel retailing, which is where they need to have physical sites as well as the internet store. And the reason this is important is that their shipping costs are a real problem. They announced the other day something I thought very interesting as they move towards logistics, because we do believe they're going to go into competition with FedEx and UPS. But they did a deal in Spain and Portugal where it's with an oil company where they have gas stations. And what happens is they have 4,000 gas stations. So if you live close to one of these gas stations in Spain or Portugal and you order something from Amazon, the package is delivered to what they call the Amazon locker at the gas station. So you go fill your car up with gas and walk in the door and get your package. It cuts their shipping costs by 30%. Now, he mentions also Facebook. Now, Facebook is all about advertising. And they between Facebook and Google, they are totally dominating the advertising industry. Now, I wanted to also show Walmart. This really looks like to me to be a downtrend situation. You know, Walmart hit a high. Now, I wanted to share this with you, though. Walmart's been a heck of an investment. If you would have bought the shares on the initial public offering, you bought 100 shares. The initial public offering was at $16.50. That was on October 1st of 1970. That $1,650 investment by December of 2003 was worth $11 million. So it has been a heck of a good investment. But it looks like to me that the Amazon world is starting to take its toll. They've made an acquisition of a company called Jet.com. Dr. Galloway is of the opinion that's going to be a real big write-off. And I talk to people all the time, and I don't know anybody that uses Jet.com. Now, I also wanted to mention Exxon. Exxon is, you know, as we talked earlier about oil prices, you know, we are seeing a situation here where the stock, you know, came down hard during the bear market, rallied back up into the 90s, pulled back, has now made a lower low. It really is important that Exxon hold in this $80 area. It's just, and the other thing about Exxon we've got to realize is that their earnings are not growing. They've got a dividend yield of 3.67%. So if interest rates go up, where you've got, let's say, the 10-year Treasury yielding 3.5%, people are going to gravitate away from these stocks and just go buy these 10-year government bonds because that's all they're really trying to do. So in conclusion, what I'm saying is the trend is your friend. Avoid downtrends and just stick with the uptrends. If you have any questions, give me a call.